Despite the fact that we're trying to really gauge where inflation is headed with all of these equal numbers, it still looks a little bit mixed, right? And we don't know how quickly, how low inflation could get. So what is for you a better clue in order to gauge where the Fed is going?
To be honest, we are all looking at the same data. We are looking at the same analysis. We're looking at the same historical models, and they can only tell you so much. Right. If you look at JPMorgan forecast, we do have inflation coming down and quite substantially over the course of the next 12 months. If you look at sequential inflation, so on a 3-month to 3-month basis, we saw a really big spike over from mid 2021 to all the way to towards the end of 3Q of this year. So after that, it's kind of subsided quite a bit in terms of headline inflation, and it's going to probably stay here by our forecasts. If you look at the various components that Fed Chair Powell has also talked about, the key black box in that whole inflation picture is really what happens to core services X housing. And that there's so many different parts to which that we don't really have very good models to forecast. It remains something that we will be keenly watching. And the reason I say this is because inflation is by far going to be the biggest factor that will drive equity outcomes in 2023, as it has been in 2022. If inflation really does come down, that will pave the path for equities to start to recover.
What about China's reopening? And are you looking at that also in the sense that we could see more demand and also adding to inflationary pressures, or is this just a net positive?
Yeah, so China demand is, if you think about the whole reopening process, equity markets obviously price that in faster. The real impact on actual consumption and actual demand by our estimates is going to take at least a couple of quarters to show through once the reopening is at least domestic reopening is fully in place. We are just in the initial steps of heading in that direction. So it's still going to be some time before you start to see upside pressure on inflation because of China reopening. And then it's a good thing that you bring it up. When you think about the overall outlook here, inflation is the starting point. So if it goes by our forecast, then there is some hope that equities could do well next year. But there are still a lot of cross currents in that DM, especially US earnings and growth, are going to be quite poor next year. And we see downside risks to that, versus what you're seeing in China is the reopening period and growth picking up in 23 versus 22. As a result, the key theme for next year is going to be convergence.
What currency assumptions are you making for next year, particularly pertaining to the fate of how that EM basket might perform?
Yeah, so our dollar forecasts are for it to peak in 2Q, but then it doesn't really come down all that much. So all in all, I would say that we're still in the strong dollar camp. And if anything, some of the EM currencies with the twin deficits, with fading reserve levels, probably go through a pretty volatile, at least first half of the year before we start to see. So the thing is, in Asia, the business cycle has started to improve. That's largely led by China. And usually when this happens, when the global cycle is not improving, equities tend to do only a little bit okay, so 10 to 15% upside, and then it fades. And that's what we are probably seeing now. But towards the end of 2023, you'll probably start to see the global cycle picking up as well. And that's when the dollar will really come down, rates will moderate, and equities will do relatively better.
When we look at the market reaction to this idea of a downshift from the Fed, it seems to ignore the expectation, at least, that's been set, that at the same time, we're going to see rates stay higher for longer, right? Do you see vulnerabilities across the corporate sector to that? And what sort of stocks, I guess, or sectors are you looking for a resilience in the margins?
Yeah, so when you think about styles, right, our two most preferred styles at this point are value and quality. And the reason for value is that the Asia business cycle is improving. So you do want to have that exposure. But quality is really for the fact that the global cycle is still deteriorating. And quality also compensates for the question that you asked, which is if rates stay higher for longer, or at least high for longer, which is our base case assumption, we don't have US 10-year, for instance, coming down substantially from these levels. And if that happens, a lot of the short-term debt that gets refinanced next year will be at a much higher level. So if you look at credit conditions in Asia, even though on aggregate, it's not really a very big risk, but you will see earnings erosion in certain pockets of the market because of these higher refinancing rates as the short-term debt gets rolled over. And you can look at we've looked at specific stocks and sectors that get affected by this. It's mostly in the utilities and industrial sectors in India and China.
The other theme that you see constructive going to next year is nearshoring beneficiaries and these deglobalization plays, right? What would they look like?
Yes. Yeah, so when you think about nearshoring, so you're looking at, firstly, the moving of supply chains for various reasons, right? One is simply cost reasons. Second is some sort of geopolitical reason for moving, trying to be more diversified or not being too concentrated in one area. And the third one is simply the domestic political need in developed markets to reshore more jobs back to the home markets. And a combination of these three things is driving this deglobalization process and moves in the supply chain. So there will be some companies that benefit, or certain markets that will benefit from higher industrial production, higher manufacturing activity coming to their shores. So that will be on the positive side. And on the negative side, you will see many of these companies that have benefited historically from globalization start to see a reversal of that. Many companies that have productions, very concentrated production, will need to invest to basically move those or end up moving to a higher cost production base, which will then erode margins.